Good afternoon, everybody. My name is Rich Harvey, CEO and founder of Property Buyer, and with me today is Dr. Andrew Wilson from My Housing Market, a very learned and experienced economist in the property market. Andrew, thanks for being with us today.
Great to be with you again, Rich. And yeah, what a year it's been, and we're just looking forward to that Christmas break, are we not?
Absolutely. I think everyone's got a lot of fatigue, either buyer fatigue, COVID fatigue, lockdown fatigue.
Yes.
We've certainly got a lot of that going on. So we've got a lot to get through. I'm really excited about this webinar. So I'm going to share my screen and we're going to get started. I'll just have to hit presenter view so we can actually get started. And let's have a look at this. Just give me 1 second. This screen number 2. And hopefully that's working. Andrew, is that screen okay there? You can see that?
Perfect. Yeah.
Perfect. Awesome. Okay. So as I said, welcome. What we're going to do today, or firstly, just My Business Property Buyer. We've been in business 20 years as buyers agents. We've hit 37 awards for excellence this year, with hopefully a few more to come shortly. I've also been the president of REBA and chairman of the Buyers Agent Chapter. Andrew, how many years have you been an economist yourself? Quite a few.
We talk about decades, not years.
Decades, mate. That's the one. Perfect. Well, that's all we need. Your name speaks for itself, mate. So what we're going to do today is a couple of things. We're going to look at the economic outlook, some of the macro data, and dive into interest rates, inflation, migration, wages, jobs, etc. And then we're going to have a look at the rental market in particular. And then Andrew and I are going to dissect particularly the big 4 banks' forecasts. We're going to look at CBA, Westpac, ANZ, and also SQM's forecasts of property price predictions for the next couple of years. And then just to finish up, we'll have a bit of Q&A and I'll give some recent case studies as well. So jam-packed program today. Hope you enjoy it. Just to kick things off and put things in perspective, I was talking to a journalist the other day and they said, look, how much has the value of property risen in the last 18 months? And what's fascinating is that, you know, our residential property market used to be around about $7.2 trillion, and that's now increased to $9.3 trillion in under 2 years. So we've seen a very, very dramatic rise in the value of real estate in Australia, but it certainly underpins very much a lot of our wealth as a nation. And if we look at just what's happening in prices, and we'll delve more into this, we can see over the last 3 months, the general headline price has increased 4.6%. The combined capital's 4.4%. But what's interesting to see, you can see here on the chart, obviously we've passed the peak of the market. We're certainly on a slowing phase of the market as we go forward. And you can see this more here on the 12-month chart. So over the course of the last 12 months, Australian headline prices have gone 21%, which really doesn't mean much. You've got to look at the individual cities, and then obviously within cities, you've got to look at the regions and the suburbs. But you know, Hobart 28%, Canberra 25%, Sydney 25%. But I do believe very strongly we are going into that sort of slowing phase, Andrew. So Andrew, I'll hand over to you, but you still believe that we've got a pretty strong market going forward. But tell us your thoughts on what's happening here with latest price changes. So I'll just bring up your charts.
Well, this sort of validates the CoreLogic data, Rich. Of course, these are the monthly changes in house prices. We can see there the Melbourne and Sydney markets have clearly eased over the last 6 months. This is the data to yesterday for all the capital cities. These are for houses. This is monthly data. Sydney's fallen down from 3% in June down to 1%. Melbourne's been a bit of a surprise packet, Rich. It's was expected, or my expectations were for a little bit stronger end to the year from Melbourne, but it has certainly fallen away. Still perhaps an overhang from what were severe lockdown conditions there. I also think that we're seeing the impact of continued migration out of Melbourne. It will be interesting to see, once borders are fully open, whether that migration surge out of Melbourne continues. But we've got to understand that both the Sydney and Melbourne markets have been the clear leaders in performance over the last 3 or 4 years, and that affordability issues are clearly pushing buyers out of the market. If we conversely look at Adelaide and Brisbane, they're going in the other direction. We're now seeing, Brisbane really surging. A lot of that is that migration factor.
Could you, Andrew, ever say that like Sydney and Melbourne are leading, but could you say that Brisbane is 6 months behind or 8 months behind? Do you ever put a number on how far behind a certain city is to other cities, or is that irrelevant?
Well, I think it's local factors that determine the rate of growth. Rich, of course, interest rates and the interruptions to markets through lockdown and other bits and pieces that we've had recently impact local growth levels. But I do think affordability is the clear issue in Melbourne and Sydney, and affordability advantages that Brisbane and Adelaide have compared to Melbourne and Sydney are continuing to drive those markets. Other local factors in Brisbane and Adelaide, obviously I've mentioned migration is a very strong factor into Brisbane, particularly those southern migrants out of Melbourne and Victoria. And in Adelaide, we've had quite a strong rebound in the Adelaide economy over the last 12 months. It, of course, Rich, as you know, has been an underperformer nationally, the Adelaide South Australian economy, for a number of years, but it has bounced back quite well over the last 12 months. And I think that, as well as affordability, are key factors of continuing with those markets to drive, because you've got to understand that the Sydney median house price is double that of Brisbane and Adelaide, same for units. And yet incomes are around about the same in Adelaide and Brisbane compared to Sydney. So there's plenty of upside there in a market that, as I said, has some economic positives in Adelaide and migration positives in Brisbane. I think the other surprise this year over the second half has been the Perth market. Perth market's really gone nowhere, despite having affordability advantages, a strong economy, and strong incomes. Its prices growth has really been, quite subdued. And I think part of that is the fact that Perth's been in the middle of a building boom with the home builder allowance. There's been a lot of new homes built. And I think because we're seeing a much higher volume in the lower priced new home section, that's acted to reduce the median prices. But nonetheless, the Perth's probably been the surprise packet this year. But the Canberra market keeps on keeping on, despite it going through a very severe lockdown period. So we're looking at two-paced markets in a sense. They're all rising, Rich, but certainly the rate of growth is declining in the previous high-growing boom markets of Melbourne and Sydney, but still clearly on the rise in Adelaide and Brisbane.
Okay, well, let's have a look at auction clearance rates too now. So we've seen a bit of a drop-off, obviously, especially the last couple of weeks. I've noticed, Andrew, just the auctions I've been attending in Sydney, and my colleagues in Melbourne as well from our team, we've noticed a significant drop-off in attendances at open houses and the number of bidders. We've seemed to have lost that frenetic activity. Brisbane's a different story. It's still a very strong market, but tell us, is there any other thing you add for those comments to these charts here, these figures here?
Well, we're seeing the typical end of year seasonal sort of impact. Rich, buyers start to, more thinking about Christmas and next year, but sellers are still, very keen to move their product before the end of the year. The Sydney had a remarkable finish to November on Saturday. It was a record day for auction numbers, all-time record day.
Over 4,000 Australia-wide, wasn't it? Yeah.
Yeah, and Sydney's also recorded the highest number of auctions over a month for Sydney over November, and still a clearance rate of 77.2%. So that was a very good result for sellers generally, given those very high numbers, fewer buyers, and of course, lots more competition amongst sellers, for product, but still strong results. And the market's holding firm despite that typical end-of-year surge. And of course, that's been added to in Sydney and Melbourne by the end of lockdown. So a lot of sellers that were, I guess, restricted from moving into the market during lockdown have now bounced back into the market. So that's added to those record numbers. But as we've seen with the price activity, the smaller markets of Brisbane, Adelaide and Canberra, they've had high numbers as well, Rich. End-of-year numbers are still tracking in good results there for sellers, although rates have come down a bit. But again, it's that same seasonal impact. Fewer buyers. Buyers are now a little distracted, but sellers still keen to finish off the year with a sale.
Okay. Thanks, Andrew. So let's have a look now at interest rates, which is a lot of chatter about that going on at the moment. So we'll just bring up your charts, but give us your view of interest rates and what's happening in the next 1 to 2 years, Andrew.
Well, it is always fertile ground for conversation, and of course the media love the interest rate story, but we can see there that first chart you pushed up there is the interest rate cycle. we've come down and down from those high rates or higher rates during the mining boom 1 and 2. And we're down now at record low. These are mortgage rates, of course, average mortgage rates. But we're now down at that 0.1% record low. We've been there for a while now. Of course, it was the emergency cut during COVID last year that brought us down to 0.1%. We had a couple of little rises in interest rates there that had nothing to do with the Reserve Bank in 2015-16 and 2018-19. And that was APRA's actions, the bank regulator. They were concerned that interest rates were going to rise. Of course, that didn't happen. And that they were concerned there were too many investors in the market and they didn't want to expose banks to perhaps investors defaulting on loans because they were highly geared. Of course, it never happened. In fact, our markets have boomed. And you can see the price cycles in relation to interest rate increases or falls over that period. You can see there clearly that obviously higher interest rates have pushed house prices down, and lower interest rates activate improved affordability. And according to local market conditions, you can see the top 2 cycles there are Melbourne and Sydney, and they had those good old-fashioned booms, but there were dips in between. It's really been a catch-up environment that has reflected that very strong prices growth in various periods in Melbourne and Sydney particularly. But I think the interesting thing from the chart, Rich, is that we can see there that it actually takes a sustained period of particularly higher interest rates to push prices down. The prices don't really collapse, they ease.
They just flatline, don't they? They just
they flatline,
Even though you've had like the mortgage rate there, 7.8%, it just stayed stable, you know.
And we had a year of or 18 months of rises before they started to ease. It was the same back in 07, 08. We had 18 months of rises and prices just eased. And that's I guess we don't think those analysts who predict sharp falls don't look at the historical evidence.
Well, I think, Andrew, us as economists, I did economics as well, but we call it sticky downwards or inelastic. You know, people are particularly fond of hanging on to their homes, and even in a high interest rate environment, they'll do everything to keep a roof over their head rather than foreclose or sell out for a loss, because people value losses more than they value gains. And I think that's why we see a very stable property market in Australia.
Well put, Rich. Yeah, absolutely. Let's
keep moving on. We've got quite a few slides, but you're saying here no more rises for years. So what are you saying about this, Andrew? How long do we see a rate rise?
Well, look, it's been 10 years since we've had a rate rise, Rich, and I think we're about as far away from our next rate rise as we could possibly be on the data. And we've already seen, sadly, some, the re-emergence, hopefully not, of another COVID strain, which may put another impediment into our economy, and that's obviously the last circumstances the Reserve Bank would be thinking about higher rates. But we just don't have the conditions for higher rates anywhere near it at the moment. Reserve Bank continues to reinforce that in its statements, but they tend to be ignored by many who are still predicting higher rates. And we can see there in its latest meeting that the RBA said that it's going to wait till inflation is between 2 and 3% on a sustainable basis. And I think that's important. It's not just going to reach that between 2 and 3%. It has to stay there for at least 2 or 3 quarters. Underlying inflation, it believes, won't reach that point until the end of 2023. So that's reaching that point. So it's then reaching the point and then staying there for a number of quarters.
So just so I can hear you clearly, you say that the RBA has to have it for 2 to 3 quarters in that 2.5 to 3% range, essentially. Absolutely. So they want to see a persistent rise in general prices until they pull the lever, right?
Exactly. And
okay, we're going to unpack this because this is important. We've got a lot of slides. I want to get to some of the reasons for this, but can we just quickly move now to jobs, Andrew? And just tell us about that.
Well, the other point to the Reserve Bank predictions are that it's not just inflation, Rich, it's also incomes. We can't have higher inflation without higher incomes being sustained. And that's the real problem in Australia's economy, is we just haven't had incomes growth. Despite all those interest rate declines, despite what looked like reasonable unemployment data, we haven't been able to grow incomes. And I think there are structural issues behind that that are against the normal process of lower interest rates fueling competition for jobs and from a hot economy and pushing up wages.
How much do we need to see wages rise by? I mean, you can see here we've been declining for a decade, right? But
well, that's
how
right.
much do wages need to rise before it becomes a concern for the Reserve Bank?
Well, if we look back to history when they last increased interest rates, Rich, we can see that incomes were rising by nearly 4%. Now, we've bounced back over the September quarter, which is a consolidation of the downturn of wages through COVID, but we're still only at 2.2%, right? So we're so far away from that 3.9%, it's not funny. And the point is, we're not really alone in this. Most advanced economies have struggled to find higher incomes with reduced interest rates. And there are other factors, technological change, migration. These types of issues have meant that we've had this cap on wages increases that we haven't seen before. But we definitely need to see higher incomes as well as higher inflation before the Reserve Bank even thinks about higher interest rates. And they've been quite clear on that.
Okay. Well, let's look also now at where inflation is sitting at the moment and where it's been the last 10 to 12 years. So obviously it's just seen a bit of a spike, just getting slightly above that 2.1% range because we've had broken and disrupted supply chains.
Yes.
Look, I guess from here, you're saying we're really not going to see much there because we've had the underlying, wages have been so low. Here's your real wages annual growth, like 0.1%. It's nothing.
Yeah, that's not really good, is it? And that inflation data, Rich, we saw a bounce back over the September quarter. Yeah. But 3/4 of the increase in the inflation rate was due to house building costs going through the roof and higher petrol prices. And of course, they're one-off factors. We've seen high house building costs because of the home builder policy. We saw a surge in demand for new houses that's pushed up labour and material costs predictably. And petrol prices, oil prices globally have increased because of the rebound from COVID in demand, and the supply hasn't been able to keep up because supply shut down. There's no shortage of oil globally. There's plenty of oil there. So these things will readjust, and that surge in inflation will work its way back to those underlying issues recently. And as you said, the real issue for the Reserve Bank is when we take inflation away from wages growth, we've basically got no real wages growth. And the last thing the Reserve Bank wants to do is increase interest rates when we've got no real wages growth. That would crack the economy.
And we're not likely to see in full employment anytime soon, which, I mean, we used to talk about full employment being around 5%.
Yes.
But we actually got our jobless rate down below that, quite recently, which is remarkable, even despite COVID. So, as you mentioned, we've got all these factors here. We've got a skill shortage going on at the moment. And we've got a lot of migrants wanting to get into the country, and they need to find work, and as you say, and find homes at the same time.
That's right, Rich. And look, we're on the way back after lockdowns, but we've still got a lot of hard work to do. We've had a lot of people actually leave the workforce. Now, they'll come back into the workforce, and there's no doubt about that. But we need to be finding jobs for those as they come back into the workforce. The unemployment rate was a bit of a shocker, rising over October. But that was because of the issues of still surrounding lockdown. But we've also got announced, although this is likely to be postponed, obviously, given current circumstances, that the government was going to allow 200,000 migrants with appropriate visas to come into the country. And that's immediately. So it's not a sort of a continued rise in migration numbers. It's a surge in activity, which will obviously create more supply for jobs, which means more competition and typically downward. And one of the factors that holds down incomes growth, in some industries. But of course, those 200,000 migrants will have to find homes as well. So that's increased demand for housing.
Let's have a look, Andrew. Let's talk about where international migration is going and where they're going to live, and also talk about interstate migration. So firstly, we've seen migration numbers crash.
Yes.
Let's put the chart up here. We've seen it crash during the COVID period.
Yes.
And obviously with this new variant strain, it's hopefully just a temporary pause for a couple of weeks. Yes. Who knows how long it might be? It might be months. We don't know. But it should resume its normal trajectory. But we definitely, as a country, we're not reproducing ourselves well enough, and we definitely need to continue to have a skilled migration program. Yes. So that's been an issue there in just those numbers. But going forward, Queensland has been getting the lion's share, right? We've seen 30,000 people move to the Sunshine State.
Yes.
Right? So why is that, do you think?
Well, I think the COVID issue is very much alive in Queensland. Queensland typically has that, the highest number of interstate and this is net migration, those coming in and leaving. And we can see there that Victoria has basically collapsed. This data is a little backward looking, March quarter. And that reflects that, migration out of Victoria and Melbourne through lockdowns, particularly into southeast Queensland. And that's a clear factor driving the Brisbane housing market at the moment, as we've discussed. I think once the international migration resumes, that the Melbourne market will, as usual, take advantage of that. Melbourne is typically the destination for international, the top destination for international migrants, and that will certainly assist its rental markets and housing markets. But of course, we still haven't got that occurring, and some issues regarding the whether we're going to see those that migration surge continue. But you can see there the collapse in international migration in Victoria, which, as I said, is typically the leader in international migration.
Like you say, I think that'll be reversed, obviously.
Yes.
Definitely be reversed. It's just a definite, which is actually has been highly reflected in the rental demand, which is, I've got properties down there and taken a hit for a period of time just because the supply is low. But talking of supply, let's move now to the supply side of things, Andrew. Just how many approvals are coming through? How many yet to be built? And there's also a big difference between approvals and commencements, right? So talk us through the numbers here, Andrew, on building approvals firstly.
Well, we've seen building approvals fall, and actually the latest data has just come out for October, but the September data showed a continuing fall in house approvals. Of course, that's the gold band there, the gold cycle, but no surprise because we've ended the home builder policy period, which saw a remarkable surge in house building. Unit development approvals have been low until recently, Rich, but the interesting thing about that is that we're starting to see a pickup in unit development from a low base, but the development's happening in Sydney. It's the Sydney market where we're seeing a revival in apartment development. And I think that's just another recognition of the undersupply of the Sydney market. And I think generally all our housing markets are undersupplied, despite that surge recently from home builder. And if it hadn't been for COVID, I think we would have been starting to really see housing shortages impact all our capital city markets. But I think into the future, because we have undersupplied our markets, that housing shortages are going to be a real issue. And I think that means upward pressure on rents and prices. And we're already seeing that with upward pressure on rents.
Yep. Okay. So if you look at, I guess, the last sort of almost 10 years here, you've got some data here, but, we were almost building 190,000 back in 2015, 16. We dropped down to almost 130,000, but crept up a bit. But as you say, we're not putting enough resources and putting enough roofs over our head. And that will have significant consequences and I guess that can give our watchers, our viewers, confidence that we don't believe the property market is going to crash anytime soon. There's a very much a strong floor under the property market. I mean, Andrew, I've been doing these presentations for 20 years, and it's fascinating to every time I put up these slides, I keep seeing the same numbers, the dips. The building approvals go up, they go down, and then you can't just turn on a tap and suddenly create 200,000 dwellings in 3 months, right? There's a very inelasticity to the property market, which both investors and home buyers can take advantage of going forward. So, look, that moves us into the next discussion about house prices. So, we've talked about supply, demand. So talk us through here where we've got the quarterly price changes happening.
Well, this reinforces the core logic data, I guess, Rich, that we've seen very strong prices growth over the September quarter, and both for houses and units. And of course, a lot of that is that catch-up energy through the interruptions of COVID and other factors over the last 3 or 4 years. I think if we look at the next slide, even though we've seen that very strong growth on a quarterly basis, you can see over the year, they're quite remarkable numbers, Rich. They're just extraordinary. 30% price growth to September in Sydney. All the other capitals above 20%, with the exception of Perth. And unit prices have also grown very strongly. I mean, to have house prices increase by nearly a third in Sydney over 12 months.
It's never, well, yeah, I don't expect it to happen again almost in my lifetime. But yeah.
We haven't, of course, we wouldn't have the interruptions and also the low interest rate catch up. But if we look at the next slide, I think Richard puts it all into perspective. If we average over the last 4 years house price growth, we can see that it's actually only averaged around 6% in Sydney. And that's because this year has been catching up on the dips, or accounting for the dips that we've had in previous years.
Yep.
So when we look at it, when we average it over the last 4 years, it's a much more reasonable, just above the inflation rate, actually, increase in house price growth. And that's where we're moving back to now, Rich. Now that we've caught up, with the markets have caught up, Melbourne and Sydney are catching up, maybe not quite caught up yet with those interruptions, but we're going to head, I believe, to that around about 5 to 6%. Annual growth going forward.
So this is a good discussion point, because a lot of people talk about when should I get into the market. It's all about the timing. But property is a great hedge against inflation. Property has always been a very stable investment for people. And I think, yes, we all get freaked out about a 25, 30% rise in prices and think how unaffordable it is for our kids, which, yeah, it is, no doubt about it. But you can either choose to be in the market or out of the market. And I'm encouraging my boys to get into the market right at this minute. I'm saying save for a deposit, let's get going, because it's not about missing the boat, it's about getting on the boat.
Yes.
And the question, when are you going to catch the train? When are you going to get on the boat? Don't keep putting it off. And I think, it's another 6%, it's another 6% or 7%, whatever it is. So I think, my message to our viewers is, get in when you can. Don't try and time the perfect entry point. Get out there and start swimming. So let's just look at the actual prices, Andrew. Sydney here, we've almost hit 1.5 million. Melbourne's just over the million. Brisbane 700,000. Adelaide 675. Perth 584, and Canberra over $1 million. So big numbers. Absolutely big numbers, but not. I would say not unaffordable. In that sense, it's all relative to what your income is.
That's right.
And the type of dwelling that you can to be able to service the loan on those properties. And then you've got a little bit here. Well, actually, we're going to talk about rental markets now.
Yes.
Actually, let's dive into that now. So the shutdown, as you say, has definitely impacted rent. So what's been impacted the worst?
Well, we certainly saw early in the lockdown, Rich, issues with the Melbourne CBD market and Sydney's inner suburban markets. Now, we saw rents falling, vacancy rates rising. And that, of course, was firstly because we had a lot of supply coming into those markets over the past few years. But we also then had decreased demand because of closed borders. Of course, migration, particularly students in Melbourne, was an important feeder into those rental markets. We also saw closed borders. A lot of the Airbnb, which had been a strong part of the market, started moving out of holiday accommodation into permanent accommodation. So that added to properties for rent, particularly in those Airbnb fertile areas in inner city Melbourne, inner city Sydney and CBD Melbourne. So it was a bit of a perfect storm of higher supply and reduced demand. First home buyers were out and about. We've had some strong first home buyer numbers in recent years. So they weren't renting, they were buying. But the interest, and of course, on the other end of the scale, we saw the reverse happening with houses. We saw a flood of demand from lockdown for those looking from a home office into houses. We also saw, of course, because the commute had sort of eased itself, people were more likely to look at outer suburban properties because they weren't commuting. So the demand for larger homes increased, vacancy rates fell, rents increased. But of course, the other factor there was we had the tap turned off for investors from APRA, and that meant that we had fewer investment properties coming into the market over the past couple of years. Now, the latest data, Rich, shows us that we're starting to see an easing in rent reductions in units in Melbourne CBD and in Sydney inner city units, and vacancy rates are also starting to tighten in those markets. But and of course, once the borders are open, we'll see a resumption of the student demand in Melbourne, particularly, and Sydney, and also tourist demand and business travellers demand, and that'll take the Airbnb equation out of the permanent market back into Airbnb. You can see there that Canberra's had has the highest rents next to Sydney, but these are quite remarkable results here, Rich. This is the latest data on the. This actually is November data, where we can see how strongly rents are now rising across the board, everywhere except for Melbourne units. And we know there are particular issues. That's all about the CBD in Melbourne, and also a little bit of migration, as you alluded to, Rich, is affecting the rental market in Melbourne, but everywhere else rents are going through the roof, and will continue to do so, in my opinion, because of this undersupply of properties that we have. And of course, rising affordability for in the house buying market, rising unaffordability means that more people will be looking to rent in the shorter term than to buy. So there'll be more demand for rental accommodation, particularly with migration, resuming. So this is an undersupplied rental market. You got to feel sorry for tenants, Rich, that they're going to do it tough with higher rents, but gee whiz, investors would be pretty happy with the outcome.
It's, as they say, it's hard enough to buy a property, but leasing a property is also pretty challenging. I'm predicting, Andrew, that within 2 years, we're going to have a pretty significant rental crisis unless we start building enough. And that's reflected also here in these vacancy rates that is projected as well. Quite significant. Obviously, below, I mean, some of the regions here are not shown, but some of the regions have a 0% vacancy rate. I'm hearing stories of 50 or 100 applications for some properties. It's insane. But these figures reflect that very tight market across most capital cities. I'd like to talk now, Andrew, just about listing volumes. What's interesting is CoreLogic have often reported that listing volumes are rising, but we're still way below the 5-year average, right? So, tell us what your numbers are showing on the listing front.
Well, obviously affected. These are new listings, Rich, coming into the market, and obviously affected by lockdowns. We can see there, but we had a very strong rebound in new listings post-lockdown. But you can see now that the trend is now starting to fall with new listings, and of course that's the usual seasonal impact. With coming to the end of the year, we'll see fewer listings, particularly new auction listings, because the auction market is now 3 weekends away from concluding. So people won't be booking in auctions now until next year. So we're seeing typically a falling away of new listings. But new listings have been, I'm not sure if we've got the comparison with next year. When we look at comparing to last year, we can see that new listings are tracking currently at around 32% more, higher than the same time last year. And that reflects seller confidence. They're happy to get into the market. It also reflects all those restrictions that sellers have had over recent years, particularly over COVID over the last 18 months, and that they're now happy to come back into the market. But again, we're starting to see that comparison with a year ago starting to ease. But this is a good thing. It's meant that we've had high volumes of sales, and that's good for governments in terms of stamp duty collections, and the economy generally has been a very positive beneficiary of what's been a strong year for sales this year.
Interesting. So what I've noticed myself working as a buyer's agent is that during the lockdown period, it was very, very difficult to buy for our clients. We were successful because we got a lot of access to off-market properties through our connections. And that was a saving grace for a lot of people trying to get into the market. But there was incredible frustration, a lot of pent-up demand, and that's why you saw very, very strong prices happen during that lockdown period. But we're starting to see more listings coming to market. Buyers have choice, and that's starting to dissipate the price pressure. So let's talk about falling affordability, Andrew, and which is obviously signalling that we're past the peak of the market.
Yes.
Got a nice slide here about the the loan affordability index.
Yes. So this is an index, Rich, that measures the proportion of your average income that you're paying for your average repayment on the average loan. It's a bit wordy, but what it means is it shows, obviously, if you start paying a higher proportion of your income for your loan repayment, it's becoming less affordable. And as that affordability or that proportion rises, affordability falls. And we can see there when we look at currently, this is the national measure, that it's at 91.76 is the measure, which is now above the long-term average of 86. And we always can see that once we exceed the long-term average, we do, the other measure there is home loans. We start to see home lending fall. And we could also put prices up against that and would see the same sort of result. And we know we've seen the trend in house price growth starting to fall, just as we're seeing home loan numbers starting to fall as well. So this is a really good chart because it shows us that markets adjust as the prices can't go through the roof because people can't afford to repay it. And once they can't afford to repay it, they can't pay higher prices and the market adjusts accordingly. And that's a way that we keep our markets sort of robust and resilient through the longer term because banks just won't let you overborrow. So you get to a point where you can't overborrow. And the other point is we've had recent action by APRA that have said that you now need to cover your income by a potential 3% increase in interest rates. And that ain't going to happen, mate. So, so even if, we did get an increase in interest rates, that proportion, it would not be affected until we got an increase of 3%, Yeah. So this is a good chart that shows us that affordability works within the banking sector, who keeps our lending criteria very tight and good on them, which means we can't overborrow. And when we try to overborrow, we can't, and that means lending numbers fall and also prices growth starts to ease as well. And that's why we can always have confidence looking forward into our housing markets. And that's why they never crash, mate.
Awesome. I might just, before we're going to go a few more slides to go, but just before we go on, I might just take a couple of questions, Andrew, that you and I might just answer, if that's okay. I'll just read them out to us. But we've got one here from Mehdi. He's asking, Rich, the Central Coast has been soaring. Will it continue to do so, or is it now at a high risk of correction? So, Mehdi, the Central Coast is a great area to buy, both for home buyers and investors. I've seen a lot of our clients buy there and also friends and family move up there. Really attractive lifestyle, beautiful waterways around Broken Bay and around Erina, etc. I don't think it's going to crash at all. I think it's going to be, it gets a lot of spillover growth from Sydney. The rents are still continuing to do well, but I definitely don't think it's in a correctional phase. I think it's just going to be like the rest of Sydney, which is going to have an easing of growth, but not go backward. Question here, one for you, Andrew. It's Charlie. He says, during the 2021 boom, we saw the higher end of the market in capital cities and regional towns outperform, and they grew at an exceptional rate. Do you think other parts of the market will catch up at some point and level things out in years to come, or will we continue to see a two-paced market between cities and regions?
Well, market energy usually, doesn't act all together. We have regions and regions within capital cities performing at different rates, but generally they do end up having the same growth over a period of time because those that are priced out of higher priced areas start to look at more affordable areas. Now, we've seen that over November, which is interesting, Rich, that the strongest growing market over November in Sydney has been Canterbury Bankstown. Canterbury Bankstown had the second highest clearance rates, but auction prices in Canterbury Bankstown have increased by 40% over the past year, which is the strongest growth of any of the Sydney regions. And its median price is now, auction price is for houses around 1.4 million. And I think this is because those, particularly in the inner west, are starting to look at more affordable areas. And this is what we see, that high prices push buyers into looking for options. And those options are, typically adjacent to moving outwards from those higher priced areas. And I think that will be part of that scenario, and that we've seen occur this year, is that higher prices push buyers into more affordable areas, and we see prices growth growing accordingly. And I think this is the whole point, Rich, that this reflects an undersupplied market, and there's no more undersupplied market than the Sydney market. That's why we don't see adjustments downwards from those higher priced areas. It's just really pushing buyers out of those areas into other areas because demand remains quite strong in inner suburban areas in Sydney.
Excellent, great. Got another question from Mark. He asks, which of Sydney, Melbourne or Brisbane would you suggest would be the best investment in housing sector for capital growth over the next 10 years? Great question, Mark. I get asked this every day of the week, and the answer is it depends. It depends on your goals. There's not a one-size-fits-all answer for that question. I think Sydney, Melbourne and Brisbane will all see significant capital growth. It just depends on your budget, whether you're able to negative gear or whether you're looking for stronger cash flow. Obviously, Brisbane, we're going to see some pretty significant rises, some immediate capital gains in that market. It's still sort of got more petrol in the tank. And you'll also get slightly higher yield. You'll definitely get higher yields in the Brisbane market. But equally, Sydney and Melbourne are also markets, as Andrew said, are undersupplied. And, it just depends on your personal situation. So I think the answer is all of those cities will perform to various degrees. Any comments there, Andrew?
Yeah, I agree completely with that, Rich. And we know that Sydney and Melbourne have had remarkable results over the last 12 to 18 months. But we looked at those averages and they're all pretty much the same when we look over 4 years. And I think, as you said, that Brisbane's got some catch up to do, and that's what we're seeing now, and likely over the next 12 months to be the top performer. Eventually those markets will even out as those, catch up energies start to even out over the next 3 or 4 years. But you're right, individual circumstances are important when you're deciding between capital cities. And look, Sydney is the most undersupplied market in the country, and yet Melbourne's got that upside once migration resumes.
Yeah, sure. Look, please keep sending your questions. I'm going to just pause the questions until the end because we do have some great questions. I will come back to them all, so please stay with us. But let's keep moving forward on it. Whoop, a couple more slides, Andrew. So just a couple of points you've made here in summary before I bring some case studies and some other points here. But just to sort of reiterate some of the things you've said, Andrew, what would you like to highlight here?
Well, look, this is really a snapshot of what's happened this year. We've had record prices growth despite those lockdown interruptions. We've seen activity released once the restrictions were lifted, and that reflects the fact that those underlying supply and demand drivers remain positive. Most capital city regions, price ranges, buyer types, property types have experienced strong pent-up demand through 2021 and higher prices. Prices growth has eased. We're seeing that as affordability declines, particularly in Melbourne and Sydney, and that pent-up demand is satisfied. The market's still an owner-occupier market, clearly. The first-home buyer activity has fallen, as we always see with high prices, because those first-home buyers don't have a trade-in to bring into the market, so they're really exposed to price surges, particularly with low prices growth. But first-home buyer levels are still above long-term averages, so there's still quite strong activity from first-home buyers. But investors have certainly surged over the past 12 months. In fact, investor activity has doubled over the last 12 months, but its market share is still below average, Rich. So that means there's plenty of upside for investors going forward, and with certainly still prospects of solid capital growth next year and solid yields. And yields are holding because of the increases in rents that we're seeing. So you're getting the double whammy there of strong yields and prices growth. The regulator has intervened, but I don't think we're going to see anything more from the regulator because prices growth has eased now.
So that was my next question. Like, if you were to say, APRA, I think, look, my view is I don't think APRA will move. I think they're watching very, very closely. But I think if the natural slowdown that's occurring continues, I think they'll keep their powder dry. They've increased that serviceability ratio by 50 basis points. My view is that they'll just hold for now and keep a very close watch. A lot of jawboning. What would you say?
Absolutely, Rich. There's completely no case for that interference. They perhaps could have tackled investors as the next cab off the rank, but as we've said, investor activity is still below average long-term levels. They don't want to be targeting first home buyers. That's a negative end for the economy and owner occupiers.
Do you know the problem I see, Andrew? If APRA jump in and restrict investor lending, we're going to see rents go even crazier.
That's right. That's right.
And the government's not stepping in and building heaps more social housing anytime soon, right?
No way.
If they go and crimp investor lending, man, it's going to be a major social problem. So
that's what we're seeing now, Rich, because of their previous actions. But I think APRA, there's no argument given that Melbourne and Sydney, who are the ultra boom markets, are certainly easing now, and in a rational, sustained downward easing of prices growth. There's just no argument. But they are acting. And APRA haven't got a brief for the housing market or the economy, but they have recently announced that they're going to be looking again at the deposit ratios and scenarios for the banks, because they're just about risk managing the banking sector. And perhaps they, as I said, they're not terribly interested in outcomes from the housing market. But again, I think the problem lies with the APRA actions, that it reflects how, because of the influences it can have on the housing market, that it does reflect how strong market power the banks have. And I think they've got to be a little bit careful of how they exercise that market power, which at the end of the day, we give it to them. They still have a responsibility to consumers and to the general economy. And they want to be very careful about just how hard they pursue their corporate profits. But yeah, look, no prospects of APRA. Now the markets are clearly easing.
Well, look, we've got some interesting discussion I want to have with you now. So let's pull apart, us as professionals, economists. Economists often get it wrong. So this was a headline in August 2020, let the bloodbath begin. Melbourne could have its worst crash since the 1890s. So there's some clickbait if ever I've seen it.
Oh, wow.
But I've pulled up here, Andrew, for our dissection here, the ANZ property forecast. And then we've got Westpac, SQM, and CBA's forecast. So just have a look at the chart here. This is ANZ. So they're basically saying that obviously this year we've had a major increase. Next year, we're looking at having sort of 5% in Sydney, 6% Melbourne, 7% Brisbane, Adelaide, it's probably 3% Hobart, 7% etc. What's your view of their predictions for next year and the year beyond?
Well, I think next year sort of is broadly what I believe prices will rise by. I'm not sure I agree with. I'm just looking at their Canberra forecast. I think Canberra will be a better mover than that. But by and large, they're showing reasonably positive growth in all the capital city markets. I don't agree with 2023. I don't think there's any scenario for price falls unless we get higher interest rates. But of course, that's what they're predicting, Rich. But we'd have to have a year of higher interest rates, in my opinion, before we had that sort of prices drop. I'm not sure what sort of homework these analysts do, but I think we've got a slide here that actually shows the long-term change in house prices in Australia since 1987, and the worst we've had is 5.1%. And there's only been 3 years where we've actually had house prices falling over a year, or home prices falling over a year, and that came off the back of a sustained period of higher interest rates. And as the Reserve Bank keeps screaming at us, it seems that they're not thinking about higher interest rates till 2024. So what I say to the ANZ, and I think the others are similar to this, is get ready to revise your forecast, guys, because I think you'll be doing that, particularly, unfortunately, given we've got a bit of a COVID scare happening as well. But there's no rationality to higher interest rates and lower house prices. Even with higher interest rates, what they would be a very marginal increase from the Reserve Bank, and it would not have an impact on an undersupplied housing market.
Okay, well, the next one I've pulled up is Louis Christopher, who's generally been shown to be quite an accurate forecaster.
Yeah, but Rich, Louis has like so many options.
Exactly. Well, it all depends on the assumptions. That's what all economists are good at, making assumptions. So he's got his base case, which basically says the cash rate is unchanged, quantitative easing is scaled back, inflation's between 3 to 5%, and APRA does take some action. And then his other scenarios is determined by the amount of interest rate rises and APRA taking some action or no action. So there's a range of forecasts here, but what's your comments on this one, Andrew?
Well, there's so many variables there that how can you get it wrong, Rich? That's the point. It's like the guy who goes to the horse races and bets on every horse and in the race and comes out proclaiming he's a winner. Well, you have to be a winner because you backed every horse. So there's a lot of scenarios here. Even the range of forecasts on what seems to be the base case are broad enough there to capture a variety of issues there. And that to me looks like a very nervous type of forecast that's trying to cover all the bases.
I personally think there's going to be some economic challenges, like obviously with another mutant variation out there. It certainly puts shockwaves of fear through the market, and certainly with some vendors out there. So there's potentially, it creates opportunities to buy well for investors and home buyers. I actually think the cash rate will remain unchanged, definitely all of next year, and then we may see. I think APRA is going to sit on the sidelines and just watch. So it's more likely to be this scenario 3 here, if you had to pick any of these scenarios, in my view. So anyway, but that's SQM. Let's move to the next one, which is Westpac. Now then, they've predicted strong rises next year as well, between sort of 6 to 10% across the other markets, and then falls in 2023. So what are your thoughts on Westpac's view of the world there?
Well, it's similar to ANZ, isn't it, Rich? And I think next year's a pretty reason. You don't have to have a million varieties to come up with something that's sort of rational next year. I don't think we're going to see interest rate increases. You don't have to have various scenarios for that. And I think we're going to see, mid-range overall around 5% increases in house prices. But again, I don't agree with the forecast for 2023. We'll talk about the banks at the end of this, and perhaps there's another agenda driving these forecasts. But yeah, it's all predicated, of course, on higher interest rates at the end of next year or in early 2023. And history just doesn't support it in any respect.
And there you've got, again, CBA. Okay, so you talk about, this is the one you really want to get the knife out for, right? And stick it in, because they're basically saying, hey, in 2023, according to CBA, we could see, 10% falls, 12% in Sydney, 12% in Hobart. Why do you think they've got their screws a bit loose on this one, Andrew?
Well, you could set your watch on the revisions to this. Look, that's the other thing we have to sort of mention, Rich, that particularly the bank forecasts come along every 3 or so months. So, what's the point of a forecast that changes? And that's the issue. Once we get the data coming out that doesn't support, which I believe will clearly not support a higher interest rate regime, then the banks just come out and say, well, the data's changed. We're changing our forecast. So that's fine. It just means it's a worthless forecast, because if you take action based on this forecast for 3 years' time, for 2023, 2 years' time, if you take action on that forecast, which changes in 3 months, you're the one, the consumer's the one, the investor's the one who's taking the jeopardy here. It's no sort of comfort for them that, oh, well, I changed the forecast, because they've made a financial commitment based on these types of outrageous predictions. We had the Commonwealth Bank make these predictions, similar predictions, in the middle of this year. Then they changed them when lockdowns happened. One of the factors we saw as a result of what was a preponderance of predictions of higher interest rates sooner rather than later was a flood of refinancing occurred. We saw people who bought into the higher interest rate potential, decided that they wanted to take advantage of low rates now and higher rates they thought, according to the banks, would be in 3 years' time. So they refinanced their properties and switched over to fixed term mortgages. Now, that has a cost, of course, to doing that. But we had a record shift or record refinancing through the middle of the year on the back of these types of forecasts. Now, it's no secret that the banks are struggling with their margins at the moment, and they are looking for new products, and they certainly have a significant profit return from refinancing, because it's not just the fee, it's also the fact that in 3 years' time, you've got to refinance again, typically. So, you need to be a little cynical about these forecasts and how extreme they are, given the history of previous issues here and how it translated into very high levels of refinancing. And the Commonwealth Bank had a very poor, relatively poor profit result recently, and their share market, the share market actually sold down their shares. So, you know, I want to play devil's advocate here to some degree, but I would be astonished, and we'll look at one of the slides, I think, that shows the historical pattern for house prices.
Let's go to your outline. I think, Andrew, this is your slide here.
Yeah.
Oh, sorry, hang on. Yeah.
So these are my predictions. They're broadly similar to everybody else's. I've got Brisbane, Adelaide, and Canberra at the top here, and I haven't got a range here. This is a mid-range, so I'm actually nominating a number like everybody else, not a dozen numbers. So, you know, I'll probably be right if I had so many numbers to predict. But I think Brisbane, Adelaide, and Canberra will be top. Sydney's still strong and undersupplied market. Melbourne a little easier, and Perth a positive market. I think there'll be some catch up there in Perth, and similar results in for units as well. But I do think that they're certainly positioned to be the top performing markets, Brisbane, Adelaide, and Canberra, and the others will record reasonably positive growth. Melbourne's been a little on the downside, as we discussed over the recent last month or so. But I think with the revival in migration, if all things pan out as we're hoping they will, that will see the Melbourne market lift perhaps beyond that 5%. But I think those numbers will be reasonably on the money by in 12 months' time. Rich, we can test it out.
Excellent. All right. So we've talked about this one. So this is your 1987 to 2001.
Yeah.
Okay.
So remembering all those ridiculous predictions, I believe, of 10% plus price falls in 2023, this is the actual ABS change in house price. These are home prices, units and houses, on an annual basis. So this measures December quarter to December quarter changes. And this is the most reliable statistical data we can get to that point, which is from 1987. And you can see there that the sharpest decline that we've had over a year in house prices is 5.1%. We've only had 3 years in that whole period where house prices have fallen. And as you can see, the periods in 2008 and 2011 were a result of sustained periods of higher interest rates, and the jobless rate was obviously low there as well, comparatively low. And we saw that with the incomes growth, and inflation was driving the Reserve Bank to push up interest rates. So to get those falls, those annual falls, would be the most astonishing result we've had in the modern history of our housing markets with reliable data. So you tell me, Rich, does that add up?
Yeah, exactly. Well, I just look at what the Commonwealth Bank did when they came out at the beginning of COVID, said prices could drop by 31%. And I mean, they've got to be kidding me. I had many clients that freaked out. And I said, don't freak out. I said, don't panic. I said, stay the course. This is one of the best times, this little window, 2 to 3 month window, where you can buy incredibly well. And I and my team, we negotiated some incredibly good discounts for our clients during that time. So what I say to anyone watching is there are little sort of portions or pauses in the market where you can actually buy really well. And that's a good time. So it's just about keeping on doing your research and keeping watching and not making your decision based on a ridiculous headline, So, Andrew, just so I'll skip through some of these comments.
Yeah, we've covered those anyway.
I think we've covered a lot of the summary. So I might just skip through if it's all right.
Yes. And I think this one here just says, if that last slide, which you've just said, absolutely, Rich, is that you've just got to be careful of all that misinformation and ignorance that unfortunately remains the curse of Australian housing markets. Do your homework, listen to those that have a consistent record of credibility, and rationalise and act on the fear that it's generating in everybody else, But we still have those issues with misinformation and ignorance, and we always will. It's just a matter of doing your homework and taking a scientific approach to your investment decisions.
Exactly. So just to, in the last couple of minutes, while we finish off, I'll just give you a couple of case studies on how we've been successful for our clients, Andrew, in the last couple of months. And this is too, if you are interested in using our services, it's our 30-second pitch, then we'd love to help you. These are the steps that we take our clients through. We look at the data, we create a strategy for our client, we provide the research, and then we start shortlisting individual properties based on the client's brief. We select and shortlist suitable properties. we appraise them, we conduct due diligence, and then we negotiate the lowest price on behalf of our client. And we charge a fixed fee for doing all of that. So if you're interested, then please give me an email or give us a call afterwards. But some interesting results we've got. Some of these are a couple of months ago. We actually been targeting a lot of properties in the Shire area, Andrew, and this was a great buy. This was one of those rare occurrences where the bank valuation came back in higher than the purchase price. It's about 1 in 1,000 when this happens, but we just found an agent that was a bit lazy, and it was really great, and they were able to get an awesome deal in Grays Point. We're also buying regularly in Newcastle. We really believe that's a market with really strong legs. It's got a great local diversified economy, really attractive lifestyle. And again, we find the yields there are very, very strong and actually rising. So, that was a 4.6% buy on a 4-bedroom townhouse that we bought. Also buying regularly in Melbourne. This was in Cheltenham, a great family-friendly area. We got this one off market at 1,275. That client's probably made about 200 grand on that property in the last 3 months because that market's gone very, very quickly, very, very strongly. We're also cherry picking some of the unit stuff in the city. We think and this is also happening in Melbourne, we've got some owner occupiers because the student population's been kind of decimated. There are some owners and investors that are just kind of like, I'm out of here. I'm sick of not getting a return. But there are also equally owners that want to move into these areas. So we were able to buy this property virtually at what the owner had paid for about 3 years ago. So it was actually a pretty decent buy, really beautiful 2-bedroom plus study apartment right next to everything, incredible finishes. So there are opportunities if you can take a contrarian view to where you think the market is at. We're also regularly buying commercial properties for our clients. You've got to be super careful what and where you buy. We've got a number of investors chasing higher yields, but we got this one for a net yield of just over 6% with a 7+7 year lease. So really solid tenant, really solid investment for our investor there. Brisbane, we're seeing some really good opportunities for positive cash flow. This was a duplex, 5-bed, so 3 beds on one side, 2 beds on the other. And that was giving an over 6% yield. We're just buying even traditional houses in that sort of 400 to say 650 range and getting around 5% yield. So really, really strong asset to add to your portfolio. Inner west of Sydney, this was a great buy. We had an overseas expat client wanting to buy a great family home, and we got this property within 30 days of them signing. So most people, take around 12 months to buy a property, Andrew. They get buyer fatigue. They get sick of looking at auctions, sick of going to inspections. But our team just speeds up that whole process. Oh, sorry, a bit too quick. This was another off-market one that I did. Lovely couple, helped them to buy a home in the local area. Again, found it off-market through my connections and was able to get an awesome deal for them. And another strategy we regularly do is positive cash flow with a granny flat. We find an old style of property on a big block of land and add a granny flat to the back. So we're doing that regularly in Sydney and also in parts of Brisbane as well. So just to finish off, Andrew, we might just pull up, by the way, there's my details. And Andrew, you're on LinkedIn. So
yes.
How do they search for you to find you on LinkedIn?
Just Doc Andrew Wilson at LinkedIn, you'll find me, and look out for a website next year.
Perfect. So just before we jump off, I'll just stop sharing and go to the questions if I can. So there's a couple of questions just to finish off, Andrew. I'll just highlight the best ones that I found here. Okay. Sorry, there's a couple in the chat. Let me just pick them up quickly. All right. Forecast for the commercial market. What's your thoughts, Andrew, just briefly on the commercial market going forward?
Well, some interesting issues with commercial, of course, Rich. Lockdown has affected the office market because we've had a change in scenarios, but they tend to be longer term. The office market tends to be a longer term commercial market because, of course, you have lengthy leases typically. But the economy is the most important factor there. I'm surprised that the office market has stood up as well as it has. It will mean a reduction in supply coming through because of restrictions and confidence issues with new building of offices. So that'll mean perhaps there's some undersupply if we get back to normal going forward. But the big winner in commercial certainly continues to be industrial and warehousing, particularly warehousing. And that's being obviously driven by the surge in online retailing, which is continuing. So I think that there's still very good opportunities in warehouse industrial development, particularly smaller ones, to do with logistics and storage. I think that there's some good opportunities there really across the board, because we're really moving almost permanently into online retailing now, Rich. And
I think that you're absolutely right. There's so much demand for logistics and that sort of thing. So I think again, it's all about buying the right kind of asset that's going to have a good return. I've got one here from Zoe. She bought a property in Queensland with Property Buyers Help several years ago. Should you hold it for gains and rent increase in light of migration and Olympics? Yeah, Zoe, I'm always a believer in long-term buy and hold, unless you absolutely have to sell it for some sort of medical reason. You're far better off, if you can, to refinance and revalue the property and use that equity increase to borrow again. But I'd definitely be recommending holding and buying again. Kelvin has asked, what's the outlook for the unit market in inner Sydney and Melbourne, given the projected return of students and the increasing disparity between house and unit prices? We kind of covered a fair bit of this, Kelvin, in the discussion, but those unit markets will recover from a rental perspective. But my belief is that housing markets will outperform the unit market long term. So certainly units are a more affordable alternative if you can't afford to get into the standalone housing market, but those markets will recover, as we've talked about. Another question here from Ash is saying, salary increases. IT and other sectors have had more than 30% hike. Property prices have risen more than 40% in 1 year. How is this sustainable? Is there an oversupply in Melbourne thanks to government handouts? I'm not quite sure what he's asking there. So sorry, we'll skip that one. Where is 500 to 600 best spent in Australia? Oh, great question from Nikki. So how long is a piece of string? Well, again, there's no one size fits all. If I had 500 to 600 at the moment, I would be investing that in Brisbane. I think that's going to get the best yield and also the most immediate capital growth. If you had a little bit more than that, then I'd be certainly considering Newcastle. But I think Brisbane would be my answer for that. What's another couple of questions here? Sorry, I'm jumping around. There's another one here. Can you explain the speed at which the property market changes, especially since 2018, from Layla? What do you think of that, Andrew? How has the speed of the property market changed? I think it's pretty much just COVID, very much COVID driven.
Well, absolutely, Rich. I mean, the market first went into, I guess, a negative period in 2018 and into 19 because of a scare campaign and those APRA actions, but it bounced back quickly because, as I've said, all it is you put a dam over the river. If you put a dam over the river, it banks up all that demand, and then you release the dam, and hey, out she comes. And that's what we've seen through all those interruptions through COVID, because prices, obviously with low transaction activity, prices just flatline. And then all of a sudden you get a surge back into the market, and that's making up. And that's why Melbourne and Sydney have recorded such strong growth this year, because they had the biggest backup of demand. And, and the underlying, driver of price growth is interest rates, which we've sort of done to death. But that's what's happened. We've had those highs and lows that have been about restricted activity and then released activity. And that's all about lockdowns and the impact they have.
Question from Peter. Hi, Rich. Do you think trends of working from home, needing more space at home, and lifestyle desires are long-term trends? Answer is yes, definitely. COVID has brought some very much long-term trends. We're seeing so many of our clients absolutely making a home office an essential criteria. We're seeing apartments being designed with much larger study nooks or even separate study areas now. And certainly home builders are factoring the home office much more into their design. So definitely a trend that's here to stay. Layla's asking, what's your prediction for COVID popular regional areas, and will CBD employers start to ask their employees come back to the office? Well, again, my view is that there's going to be a new hybrid of working. I think we're starting to see the Monday, Friday work from home, Tuesday to Thursday in the office. Just look at the traffic. It tells you what happens there in the cities. But I think we're going to have a bit of a swing back toward the cities over time because of simply the word collaboration and socialisation. I'm hearing that a lot of people are missing the interaction of their colleagues, and I think there'll be the best of both worlds. And that's why places like, an hour to 2 hours out of the cities will also perform quite well, because people can have, travel or commute for a shorter period of time in the week and have their workplace and also have their lifestyle at home. What else have we got here? We've got some other questions. It's really an affordability question here, Andrew. If wages do not grow, but housing prices do, will we reach a point where it's simply unaffordable? And will people be driven out of the market?
Well, we can't see house prices rising without wages increasing, because how do you pay for it? As long as the bank is saying, no, we're not going to let you borrow more than 25% of your income, then you can't borrow more to pay for higher house prices. So that's the stabiliser, and most properties are purchased under a mortgage. So, you need higher incomes to have higher house prices, because the banks won't let you pay more unless you can afford to repay it under their criteria.
Another question, do you see international migration as a key source of upward pressure on the higher end of the Sydney and Melbourne market? Well, international migration, yeah, absolutely. It certainly contributes to that. But we're just seeing certainly a lot of wealthier people wanting more, higher profile or higher quality properties. So naturally, even within the Sydney and the Melbourne market, people are upgrading their digs and upgrading their properties to want, and certainly migration will just simply continue to that. Just see, yes, people want a copy of the recording. Andrew, are you happy for me to share?
Yes, absolutely, Rich.
So, yeah, we'll be sending around a link to everybody, and also a copy of the slides so you can watch them at your leisure. The Perth projections are much softer than Brisbane and Adelaide in all forecasts. Why do you think Perth is not going to catch up like Adelaide and Brisbane?
Well, Perth's been the problem child to some degree this year, Rich. It was certainly predicted to be at the top of the market because of strong economy, affordability, and lots of catch-up to be doing. It sort of panned out reasonably well the first half of the year, but it's gone flat the second half of the year. I still think there's upside potential there, but it shows perhaps that it won't catch up. Prices in Perth are still below where they were 7 years ago. And affordability and relative affordability can actually change over time, because people get used to the price floors in markets in real time. And it really doesn't matter what prices were 7 years ago, if you understand what I mean. But Perth still ticks the boxes. It's a strong economy. It has high incomes. It's done a lot of building this year, but that building hasn't been spec building. It's all been contract building. And its prices are the lowest in the country now. So you would suggest on those criteria that it had upward potential, but and I think it does. But I think that catch-up scenario has moved past the Perth market. We need to be a little wary of the measurement process in Perth. We may be now measuring sales that are new property sales, and they've had a remarkable boom in new house starts in Perth. In fact, the second highest in the country, only behind Melbourne, for houses, and that may be dragging down the medians.
Okay. And one last question, and I'm going to give you a 30-second time limit for this one, because I know you'll talk till the cows come home. If Labor abolishes negative gearing and capital gains tax, will prices drop?
Well, that'll happen when pigs fly. That is the changing of the negative gearing. They've already announced it's not going to happen. The one thing about political parties is when they're burnt once, they never forget. They're like elephants. And the Labor Party, with much kicking and screaming, have conceded that it's electoral poison to try to change those property taxes. So it'll be a long, long time, and they'd have to be a very, very strong government to risk that again. And I think, just to finish off on that, Rich, it's interesting that the New South Wales government is now backtracking on changes to stamp duty, replacing it with a land tax, which I always thought was going to be an outcome, particularly after such a massive year for tax.
They're addicted to it like a drug, aren't they? It's a shame, because I think it would definitely, if they did reform stamp duty, it would definitely free up transactions a lot more, be so much healthier in the economy. So, well, look, can I just say, Dr. Andrew Wilson, thank you so much for joining us today. Great pleasure, great insights as always. Thank you to all our viewers for watching. We really appreciate your participation, and we will be sending around the slides and a link to share with your friends. Please stay tuned. I'll be sending out my newsletter tomorrow talking about, is there a looming rental crisis? So keep your eyes peeled for that. But thank you again. And if you'd like to contact us, Dr. Andrew Wilson, My Housing Market, look him up on LinkedIn.
Yep.
He's got some great information there. And my website, propertybuyer.com.au, or just give us a ring based on the links that we send you. So thank you guys. Really appreciate it. Have a safe and happy Christmas, and we'll see you again soon.
Thanks, Rich.
Thanks, Andrew. Cheers.